honorable guest speaker today. As you all know, NATS is a non-profit voluntary organization spread across the states with several chapters. We have been doing wonderful service to our community. I would request everyone to reach NATS for any help with respect to community or support. We have NATS helpline. Email address is helpline@natsworld.org, or you can call 1-888 for Telugu. We will be delighted to come and help wherever possible and virtually whatever is possible. With that, I would like to introduce our honorable guest speaker today, Mr. Anil Gandhi. Anil has been involved and helping community with all aspects of legislation, tax planning, and policies. One thing very good about him is he is up to date about latest tax changes, planning, and all those. We are very lucky to have him today to discuss some of the latest changes with us for our community's help. Until with that, I would request you to take over from here. Thank you so much.
Thank you very much, Prasad. Thank you very much, and thanks to NATS leadership for giving me this as an opportunity to share my knowledge with my community members. Thank you very much. So in this session, whatever I am sharing, I am just trying to share my knowledge and with my community members. And please don't take any, please don't implement any strategies, recommended strategies for your personal case without talking with your CPA or tax accountant or tax preparer. Otherwise, meet me in schedule meeting with me one-on-one before you implement any strategy. Because whatever we are going to share now is a very generic sense, and which may be applicable for many of you guys. So please follow. Please talk to your tax accountant before you implement any strategy. So before you get into this topic, I worked in Amazon, Starbucks, PricewaterhouseCoopers, and Sun Edison. Sun Edison was the world's largest renewable energy company, and I was the finance controller for Indian operations. And I have been helping so many small business owners in respect to tax planning, CFO, wealth management, and filing tax returns. On top of all, I do also have a team of professionally qualified, licensed CPAs, chartered accountants, and other finance professionals. So recently, even my articles are published even in the Forbes. Also, there are many articles that are published from me. And I do also have a TV live show every week exclusively designed for the tax planning strategies. You can go to the YouTube and so you have to take steps much faster to file your tax returns on time. And if you are an individual or C corporation, you can file the tax returns by April 15th. And please, and I always recommend all my clients and also to my friends to file the tax returns as soon as possible, because you can get more time from your tax accountant or CPA to review your tax return in more detail rather than running at the last minute rush. So, why do we need to know more about taxes? How does that matter to us? So this is one of the examples. From one of the recent, one of the survey results, they have done some survey just to look into that. What are the major expenses in a family? Just you think yourself once. What is the major expense in a month, every month in your family? You may be thinking about maybe some medical expenses, or maybe mortgage payments, or rental payments, or some medical, or many other, maybe some food expenses. But most of you would have missed a very big thing, which is the tax. The average tax rate is approximately 30%. From your paycheck every month, you are paying approximately 30% in taxes to the IRS. And don't forget, IRS Uncle Sam wants you all the time. You earn money, he needs a tax. You spend the money, you need to pay taxes. You save money, you need to pay taxes. And you die, there is an estate tax, you need to pay taxes. So whatever you do, whatever money you make, you need to pay taxes to Uncle Sam. But why? But what I noticed is, I have few hundreds of business owners, individuals as my clients. But what I noticed is, most of us don't spend a lot of time in analyzing what are the tax saving opportunities we have. We spend a lot of time and effort to earn a dollar. Do we spend enough time to save the dollar what we earn? On average, we spend 35% to 45% in taxes based on which state you live. So I strongly recommend everyone to spend some time on tax planning, how to save those dollars what you earn. So and the planning has to happen at the beginning of the year and not at the end of the year. So now in this session, I'm focusing more on tax planning. So what you should do for this year, because we just started our year 2021 year started, and if you know what is to be done from the beginning, so then the probability of saving taxes by end of the year is much higher. So this was the one statement given by Benjamin Franklin a few years back. In this world, nothing is certain but death and taxes. How many of you agree with this? You have to pay taxes, and you can't stop this. But this statement is overwritten by our Amazon. So I was working in Amazon when these results were issued. In 2018, Amazon net profit was $11.2 billion, but they paid zero taxes. How this is possible? This is possible by implementing a lot of tax saving strategies. And just see, you might have seen this recent New York Times article. Trump paid $750 in federal taxes. When we are paying hundreds of thousands of dollars in taxes, or maybe $20,000, $50,000 based on if you are a W2 income or based on your income levels, how come very big shots are able to save a lot of taxes? Because they have tax planning strategists in their team who help them to save taxes. If you're a small business owner, you might be reaching out to your CPA or tax accountant only at the time of filing your tax return. That is wrong. You need to do the tax planning throughout the year. And there are ways. I'm not saying that everyone can pay only $0 or $750 like Trump. But definitely there are possibilities in saving taxes. And what is the basic difference between tax planning and preparation? So in general, at the end of the year, during the tax season, before this March 15th and April 15th, if you're running to file your tax return, which is called tax preparation, it's a process of preparing the tax returns to submit to the IRS. But if you do any planning before end of the year or beginning of the year, by looking into the person's life, business, and regulatory requirements to legally reduce the taxes, there are many ways available. I'm going to discuss a lot of strategies today. So, but if you can plan like this is called tax planning. It has to be done at the beginning of the year. And many people ask me, hey, if I don't pay the taxes to IRS, is it a crime? Is it a problem? Is it a problem? Will IRS come back to me? Will my file get audited? There are many myths in these statements. So taxes can be saved, or you can avoid paying taxes by two ways. One, tax evasion, tax avoidance. Tax evasion is not following the fair practices. which is illegal. But tax avoidance, it is legal. There are many tax saving strategies are there. Just go find out what suits for you, get it and implement it. Even Trump has given a statement during the elections time. Someone, one of the press guy asked him, how you are paying only $750? He told, the tax code is passed by the Congress. There are many strategies available. It is up to you how to use the resources, how to use the opportunities. If you are not able to use the tax planning strategies, it's you. You are doing the mistake. You cannot blame anyone. It's you individually. No one will come and tell you, hey, do this, do this, do this. No. You need to spend time with your tax accountant in saving taxes. So tax avoidance is not an illegal. It is legal. So only you need to find out which provision allows you how to save taxes. First, I want to start with very basics on individuals. I'm covering. I split this into two parts in tax planning: individuals and the business owners. If you're an individual, don't forget every individual is also. Every business owner is also an individual. So if you're a business owner, you might be filing a separate tax return for the business, but you also need to file an individual tax return. So individual is applicable for everyone. So we will get into the individuals. Health savings account. If you are healthy and you don't need to visit to the hospital so frequently in a year, then I strongly recommend to think about this health savings account. This is one of the best strategy IRS has. Health savings account has a lot of benefits, but the condition here is to open this health savings account. You can open an HSA account and you can contribute some money every year, and that money has to be used only for the medical purpose. So what advantage I get if I do this contribution? I'll explain this now. The first one, you can have HSA account only when you have high deductible medical plan, high deductible health plan. If you don't have this high deductible plan, you are not eligible for this. If you don't have it already, but if you think that you are if you don't have high deductible plan as of now, but if you think you have good health conditions for all your family members, then I strongly recommend you to open HSA account. Very, very, very good one. What are the advantages again? First, whatever contribution you do every year, it is tax deductible, and you can use that money for any medical expenses, out-of-pocket expenses, maybe some maybe over-the-counter expenses, over-the-counter medical purchases. If you do it for any medical in co-pays, you can use these balances, and you can use this either this year, next year, or when you retire, or even after you deceased. Even your spouse can also use these funds. And at the end of the year, if you don't use the funds, don't worry, it will be roll over to the next year, next year, and next year. So then, maximum how much you can contribute? You can contribute up to $7,100 if you are filing, if you have a family, and if you are 55 years and above, you can contribute $1,000 extra. And whatever money you contributed, it is completely tax deductible. So it has triple advantages. Number one, whatever you contributed, it's completely tax deductible. Then it grows. It has a tax deferred growth. This money you can invest in the stock market. Even you have an HSA account, many people don't know this. You can open a stock brokerage account. You can invest in mutual funds, stocks, bonds, anywhere. And whatever you withdraw money for the medical purpose, those are tax deductible. Those are tax-free withdrawals. But you rolled over the money. You build the wealth. You build a lot of money in this account in the next 15-20 years. But if you're not able to use it for your medical expenses, then still you can withdraw money, but it works like a 401k account type. When you touch the money out, you need to pay taxes. But as long as you use it for the medical purpose, this is completely tax-free. And we are very sure once you retire, once you become older, definitely we need a lot of money to take care of medical expenses. And the beauty here is even your spouse also can use this. Even we can, if we have any dependent kids, we can use for them also. And the next one is retirement plans. Many of you might have heard of a lot of retirement plans. But most of you might not be following in a right way to maximizing your retirement savings and also tax savings. So there are a lot of options are available in retirement planning. In US, as per the statistical reports in the first slide we have seen, less than 1% of US American citizens save money for their future. So IRS has come forward and say that, hey, come on, if you, their IRS have come forward and said, if you save money for your retirement, I will save you more tax benefits. So there are a lot of strategies are available, and every one of you in the call can contribute to the retirement plans. So there are, I will explain all this, what is applicable for you, what you can do. The first one, 401k account. Hike 401k. I'm not asking you to contribute to the 401k. I mean, you contribute because everyone knows, hey, 401k, I know this already. But the thing here is, if you are already contributing the 401k, what I noticed is most of us are not optimizing it. You can contribute up to $19,500 as an individual, and whatever you contribute, you get a tax deduction. But it grows tax deferred. But in the future, whenever you withdraw money, you need to pay taxes at the time of withdrawal. But and if you, and I do also have a lot of clients who are not actually doing a lot of the 401k contribution, even they are missing employer matching. But I've been recommending them. If your employer is doing any matching, 3%, 5%, 2%, you should not miss that. You should not miss that. You may be having a lot of questions. Hey, I want to go back to India, what to do and everything. For everything, there is a solution. I'm not covering that topic here, considering the shortage of the time. But definitely, I strongly recommend to contribute everyone to 401k account. In 401k account, there are two types of accounts: traditional IRA, traditional 401k, Roth 401k. Traditional 401k, which I explained, when you contribute, you get a tax deduction. It grows tax deferred, but when you withdraw money, it is taxable. But Roth, it is complete. Whenever you contribute to Roth, you don't get any tax deduction, but it grows tax free. When you withdraw money, it is completely tax free. Roth is one of the best strategy IRS has it. Every member, whoever is attending the call today, should have Roth contribution. It's Roth account. Roth account. There are different types of 401k account, IRA account, which I will explain. Everyone should have Roth account. So, what are the major differences between 401k and Roth? So, for Roth 401k, you can contribute up to $19,500. For Roth, you can contribute up to $6,000. It grows a bit. You can contribute more if you are 50 years or more, and both work in the same way. 401k and IRA works in almost the same way. Like, you can take the money only when you are retired. If you want to take the money before you retire, you need to pay 10% penalty, and you also need to pay taxes on this. So, and one more thing is IRA account. I'm sorry, IRA account, you can contribute even your wife is not working. So for 401k account, it has to be supported by employer, but for IRA, anyone can contribute. I'm talking about only contribution, not about the deduction. So when you contribute, anyone can contribute. Everyone can contribute to IRA $6,000. And for your wife, even though she is not working, you can contribute $6,000. But the point to be noted here is there are some income limitations. If you're contributing if your salary is more than $124,000, married filing jointly, then you don't get the tax deduction for the IRA contribution. But still, I recommend you to contribute. Why do I need to contribute? I will cover that in the next slide. So, as I was saying, traditional, when you contribute, you get the tax deduction. But for Roth, when you contribute, you don't get the tax deduction. But there is one more option called backdoor Roth. Very powerful tool. So in general, 401k account, just think about how much money you have in your 401k account. Maybe $200,000, $400,000, $500,000. Whenever you touch that money to withdraw, you need to pay 30, 40, 50%, whatever the tax rate at that time. So whatever you see, that is not yours. Some share you have to give it to the IRS. But if it's a Roth, whatever you see is completely your money. So there are some ways how you can build Roth accounts. It is applicable for 401k and also IRA account. When you contribute to the, like I will take one example. When you contribute to the traditional 401k account, you get the tax reduction. But I was saying about IRA, if your income is more than $124,000 or if your income is more than $206,000, then you cannot contribute to the Roth IRA account. And even you can contribute, you don't get the tax deduction. Then why do I need to contribute to the IRA account when I don't get the tax deduction? This is where you need to understand. There's one more concept called backdoor Roth. What you can do is you contribute to the traditional 401k or traditional IRA account, convert this to the Roth IRA account, transfer the balance to the Roth IRA account the next day. After that, it grows tax-free. You can invest wherever you want. It can be mutual funds, stocks, or bonds, or there is also one more concept called self-directed IRA, but I'm not covering it here, considering the shortage of the time, where you can invest even in the real estate also. So you can invest wherever you can invest money in the stock market in general, and whatever money it grows by the time of your retirement, it's completely tax-free. So every family can contribute up to $12,000 every year. You can contribute $12,000 for the IRA account, and you can convert this to the backdoor Roth IRA account. So don't miss this opportunity. Then this is what I was talking about, backdoor IRA. When you contribute, you contribute to the traditional IRA, but after that you have an option to convert this to the Roth IRA account. And I strongly recommend this for the high net worth individuals whose income is more than $206,000, because they cannot directly contribute to the Roth IRA account, but they can follow this process. Even you are a $1 million earner, still you can contribute to traditional IRA, convert this to the Roth IRA account. And the other important point here is you can contribute to the IRA account even though you have a 401k account. If your CPA or tax accountant is saying otherwise, it's a time for you to change your CPA or tax account. These are very basics. If your accountant is not able to answer your basic questions properly, it's time for you to look for change. So then, Roth IRA, as I was saying, this is one of the great tax tool you have, Roth IRA account. So if you start contributing as early as possible, you can build millions of dollars by the time of retirement, which is a completely tax-free. Even I do also have a separate exclusive how to become a tax-free millionaire Roth IRA account. You can go to the YouTube and you can search on this name. You can find a design. I well explained the entire strategies how to implement this, but you can make millions of dollars tax-free if you have a proper Roth IRA account. And apart from this IRA account, 401k account, you do also have a SEP IRA, simple IRA, and also a lot of pension funds also available. So I am covering only few now, considering the shortage of the time. This is my favorite retirement account, solo 401k account. In America is a land of opportunities. It's a land of opportunities. Every person should have a side gig. Some business you should do it. As long as they have the valid visas. Okay, they can do real estate. They can become a real estate agent. They can become a financial advisor. They can become a freelancer. They can become a photographer. They can become a nurse or anything. Whatever you do. And if you have a self-employment, then if you don't have any employees, then you can contribute to the solo 401k. You can contribute up to $57,000 in a year towards the solo 401k, and it is completely tax deductible. So you will be saving thousands of dollars on solo 401k. But you can do this only when you have a self-employment. If you are working on a W2 employment, no. So if you are working on W2, you are not eligible to contribute to the solo 401k. If anyone has a side business, and if they don't have the solo 401k, they are missing a lot of opportunities. And apart from the solo 401k, you do also have one more option called SEP IRA. How does the SEP IRA work? You can contribute up to 25% of your income to the maximum of $57,000 into the SEP IRA. But I'm not going in detail the comparison between solo 401k and SEP IRA, but SEP IRA is also a great tool if you miss the solo 401k, because you can contribute to the SEP IRA even before filing your tax return. It means For 2020, you can contribute, you can open an account now, you can contribute now, and you can get a tax deduction now before you filing your tax return. But for solo 401k, you cannot open an account now. It has to be before December 31st, 2021, 20 or 21. Then charitable deductions. This year, you have an option to get a charitable deductions if you do any charitable deductions. So you can contribute. Actually, if you are single, you can contribute. You can do any donations to charitable organizations, and you can get a tax deduction of $300 if you are a single, $600 if you are a filing marriage jointly for this year for 2021, and you can get this even though you are filing your tax return at a standard tax return. So there are two types of tax return: standard tax return and itemized tax return. If you are filing a standard tax return, in general, you cannot get any deduction for your charitable contributions. But from this year and for the last year and this year, because of the COVID, IRS has extended the support by giving extra deduction even though you are filing a standard tax return. And for this year, you can even do the 100% for 2020 and also 2021. You can do 100% of your adjusted gross income as a charitable donations. So this is a very good one. If you do a lot of charitable activities or charitable donations, this year could be a great year, because in general you can contribute only up to 60% of your adjusted gross income for charitable activities. But now you can contribute up to 100%. And you do also have one more option called set up donor advisory fund. You want to do some charitable activities, but you are not very sure to which organization you want to do the charitable charitable donations. You want to go and help your hometown. Maybe you want to help a school, you want to help a orphanage center at your hometown, but you need a lot of funds for that. So what you can do is you can open a donor advisory fund, in which you can open it in Vanguard, TD Ameritrade, or Fidelity. You can open. It's an online account. You can contribute to those accounts, and you get a charitable. You get a deduction this year, but you can accumulate the funds year on year. This year 5,000, next year 2,000, next year 5,000. Once it accumulates to 50,000 or 100,000, whenever you want, then you can identify an organization like NATS, North America Telugu Society. You can give it to them, and you can ask them to donate those funds to in India, maybe at your home place. So this is a very great strategy, so that you don't need to worry. Every year you can do small contributions. At the end, you can give a very big donation to your hometown or any other charitable organization at the end of the period, by 5 years, 10 years, 2 years, whenever you want. So this is also very good too. And as this is the tax, as it's a tax returns filing time, most of the tax strategies has to be implemented by December 31st, 2020 or 2021, end of the year. But only few cases, you have an option to contribute now before filing a tax return. Still, you get a tax deductions. It's like HSA, health savings account, which we covered, traditional IRA account. Even for the 2020, you can contribute now before filing your tax return. ROTH IRA account, you can contribute for the last year now. And profit sharing retirement plans. If you have a solo 401k account, there are two parts: profit sharing and employee contribution. You can do any retirement plan contributions also now, but you can do it only if you are a sole proprietor, or if you are a self-employed. And 529 plans, if you have 529 plans for kids, you can do the contribution before filing your tax return. And the last one is SEP IRA. As I explained, before filing your tax return, you can open an account now, and you can contribute SEP IRA before filing a tax return. All these strategies, if you implement, before April 15th or March 15th, whatever the dates applicable for you, you will be saving some thousands of dollars with this one slide. If you implement all those, if you optimize all these strategies. Then, my favorite. I brought up in a business family. From my childhood, from the age 8 years onwards, my personal story. I am taking care of my businesses. I actively participate in all my businesses. My fathers, my grandparents, my uncles, aunts, everyone is into the business. So I love business owners. I love to help small business owners. So this is what my vision. After completion of my 15 years of my journey as a finance controller, CFO roles, Then I quit my job just to help, with the intention to help many more business owners to the extent possible. So see how many strategies we can implement as a business owner. As I was explaining, if you are self-employed or if you have a single member LLC, and if you are making more than $50,000 net profit in a year, I strongly recommend to go and opt for S corporation. The advantage of S is a legal entity structuring. If you are a single member LLC, if you have more than $50,000 income net profit, then convert into the S corporation. What advantage I get by converting an S corporation? If you are a real estate agent, most of the real estate agents, they have single member LLCs, or just they do like a sole proprietorship. They are not realizing it, how much extra taxes they are paying. Just by having a proper legal entity structuring setup, you can save thousands of dollars. How do you save taxes if you have an S corporation? In general, if you are a sole proprietor or single member LLC, you need to pay social security taxes, which is 15.3% on your entire net profit. But if it's an S corporation, you don't need to pay 15.3% on your net profit. An example, if you have $100,000 income, but S corporation, there's one more clause I forgot. For S corporation, it's a mandatory salary. You have to run a salary. In general, just I want to give one example. If you are a single member owner, single member LLC, if you're a real estate agent, I'll take just real estate agent example. If you might be working on W2, you might have some side gig, side business, which is a real estate agent or financial advisor. And if you have $100,000 income, you need to pay social security taxes on $100,000, which is a 15.3%. But if you convert this into an S corporation and you take a nominal salary, reasonable salary, maybe 30,000 or 50,000, on the balance $50,000 net profit, you don't need to pay social security taxes, which is 15.3%. On $50,000, you will be saving $7,500 approximately. It's a very big number on year basis. So this is a very great strategy. And if you have any questions, I'm happy to answer. And vehicle depreciations. If you are a small business owner, or if you're a big business owner also, if you have a vehicles, you can claim depreciation. If you have a vehicle which is more than 6,000 pounds, I'll give some examples. Model Tesla X, BMW i5, Honda Odyssey, Range Rovers. Those all are vehicles weighs more than 6,000 pounds. The beauty here is if you buy the vehicles, you can claim 100% depreciation in the same year you bought. So whatever price, whatever income you have from your business, flat 100% deduction in the same year. You can if you have some vehicle last year, if you bought a vehicle last year, still you can claim depreciation. I mean, when you're filing a tax return. Or this year, if you're planning to buy a vehicle, think about this. If you're thinking about going for a vehicle on the lease, you are missing a very big tax saving tool, which is a vehicle depreciation. For business owners, I always recommend to go and buy the vehicle on financing model or cash down model, not on the lease. If you go on the lease, you miss this opportunity of vehicle depreciation. So then, apart from this, you can also claim expenses. You can claim home office expenses like utilities, insurance, HOA, security, mortgage interest, property taxes, as long as you have an exclusive space in your home which you are using for your home office purpose. Travel expenses. If you have a business, you might need to go and visit some vendors, customers, suppliers, or identifying if you are a real estate agent if you are a real estate investor or any other, if you're doing flip business, identifying the properties. You might need to attending conferences, seminars, wherever you go. All those expenses are deductible business as long as they are business related. Meals categories. If you go out and have lunch with your vendors, customers, suppliers, or any potential customers, potential prospects, then you get a tax deduction up to 100% of if you spend the money at the restaurants for this year. And hiring children, my favorite topic. If you have a teenagers, why can't you hire them? Pay them some salary. And there are a lot of advantages which I will cover in the next slide. Maximizing depreciation, which I covered, bonus depreciation in section 139, where you can 179, where you can claim up to 100% depreciation. Healthcare strategies. If you are paying some health insurance policies, health insurance premiums, medical expenses, out-of-pocket expenses, co-pays, all those expenses can be deducted from your business. Accountable plans, out-of-pocket expenses, mileage, home office, travel, and startup cost, like laptops, monitors, printers, technologies, or if you're buying any software tools, website designing, or if you're paying anything for your tax advisor, attorney, legal advisor, consulting, cameras, if you're buying some cameras to do some marketing to take marketing pics, if you're buying any office supplies, furniture, all those expenses can be claimed. Please note, these expenses can be claimed only if they are legitimate and business purpose. I am not misguiding anyone here to claim something which is wrong. I'm talking about whatever I talk, it's legally. Whatever I say with the section reference number, I have a tracking. So don't misuse these opportunities. Please use it in a right way as long as they are legitimate. Please work with your tax accountant or CPA when you are implementing when you are claiming any of these expenses. Turn your passion. See, when I was explaining all this, have you not thought, hey, I should have some business? You should get that idea. If you are not having a business, you are missing a lot of opportunity. Turn your passion into the business. You might be knowing my background or no. I was working in Amazon, full-time role. I quit my Amazon full-time job just to convert my passion into the business. When you convert your passion into the business, you will be very successful, very positively, very successful. And see how many tax benefits you have. If you are the business owner, you can claim all this only when you are a business owner, and as long as they are legitimate and business related. So if you have some passion and if you have valid visas, I strongly recommend you to start some business aside. It's a land of opportunities. There are a lot of opportunities. I have been helping so many business owners in giving a lot of business recommendations. I'm happy to share my knowledge as required. And as I was explaining, you can claim home office deductions only when you can use them for exclusive and regular use purpose. So if you should have some dedicated place in your home which you are using exclusively and regular use for your home office. And hiring children. Just I'll do a small deep dive about hiring children. This is one of the most powerful tax strategy which can be used only by the business owners. If you're on W2, I'm sorry, you cannot do this strategy. So what is this? To do this, to implement this strategy, you should have either sole proprietorship or partnership in which each partner is a parent of the child. So you should have a sole proprietor or partnership firm business to do this, to pay salary to your kids. And kids under 18 years old only can be recommended. I mean, we recommend to hire your kids who are under 18 years, because you don't need to pay social security taxes, you don't need to pay Medicare taxes, there is no withholding taxes, and they are also not required to pay any taxes they are not required to pay any taxes if their income is less than $12,000. There is a standard deduction is applicable up to $12,400. An individual is not required to file a tax return, or they don't need to pay taxes. See the strategy, how much savings you can do. If you have two kids, both teenagers, you can pay $24,000, but please don't misuse this. Pay them, get the work done from them. Don't just like that, don't pay them. If you pay them, then you are, you need to have a lot of documentation is required, timesheets are required when you implement this strategy. But still, it is doable. Someone asked me, my kid is only 14 years, still can I contribute? Can I hire them? Answer is yes. Go and do the Google search. There are multi-millionaires who are very young at age of 11, 9, 10, 12, 15 years. Why can't your kid be? Your kid can also become a multi-millionaire, a big entrepreneur. But please note that, and please note that the advantage of hiring the kids are you are training them at home before they go and hit the job market at the age of 20. and you are making them self-reliant. Pay the salary, but get the work done. We don't pay salary blindly, and teach them, and bring the entrepreneur skills in them. Build entrepreneur skills, build accountability, responsibility, ownership. Train them, coach them. They will be super successful. And on top, it's a what you call the cherry on the flower on the ice cream. You can also do that. Once he gets an income salary every month, he can also contribute to a Roth IRA account. Just imagine $6,000 every year he can contribute to his Roth account, and by the time of retirement, he will make millions of dollars in the retirement account, which are completely tax free. And it's a great opportunity. Only business owners only have this opportunity. W2 employees, sorry, it's not available for them. And if you are a S corporation owner or if a C corporation owner, these strategies are not straightforward. Please work with your tax accountant or CPA, or you can reach out to me later. I'm happy to guide you. But this is at very high level. But when you implement it, you need to be ensured you have proper documentation. You are following all the guidelines given by IRS. Though if you do anything mistake in the implementation, it will backfire on you. And this is a tax saving tool. As long as you train your kids, you make them work for you. So I am not misguiding anyone. Please don't consider like that. Then paying spouse. How many of your spouses are not working outside, but still they are helping you at your business? If they are not helping you at this point, make them involved into the business. Get their ideas also into the business. Make them assign some responsibilities to them. Make them work. If you're self-employed, make them work for you. Make them help you, and you can pay salary to them. And the beauty here is whatever salary you pay to them. Example, if you pay around approximately $21,500, they after the taxes they can after social security taxes they can pay $19,500 to their 401k account, and they will not be paying any income taxes on this entire salary whatever you pay to them, as long as it is lower level. If you're paying it higher, sorry, if you're paying it higher level, then if you're filing a joint tax return, there is no advantage. But if you're minimizing, just you need to think how much salary you can pay. Again, when you implement this strategy, please work with your CPA or tax accountant. Then this is about my recommendations for the business owners, which they need to consider in the year 2021. If you start doing it from now, then only you can save thousands of dollars. I am sure if whoever attended this webinar today, if they implement even couple of strategies this year, they will be saving few thousands of dollars. But please work with your CPA before you implement any of those guidelines, any of those strategies. And Biden proposed tax plan, I think that is over. Tax planning for the business owners, individuals at over at high level. Still, I have a lot more topics, but maybe some other webinar, because consider we need to cover 2 topics and the time availability is very less. So I covered only few ones which makes you attractive, which you can implement it. And number 1, Biden proposed tax policy. The next topic, Biden proposed tax policy. This year, in the law, not this year, since last March, there are so many changes are coming up in America, and few of them are because the coronavirus. And when the coronavirus was there, there was a CARES Act was introduced. There are stimulus payments, paychecks, PPP loans, EADL loans, employee retention tax credit. There are a lot of changes have been coming. We have been facing for the last 1 year, and November, December elections took place. Now Biden has taken over. Biden has taken over as the president, and now still many more changes are going to come. If you go and see the Biden's calendar, he's working with different different departments to do lot of changes. And in that, one of the biggest one we are expecting is one more tax reform. He's coming up with a lot more changes in the taxes, and he's doing for good for the company, for the country. But there is an impact for the individuals and also for the business owners. So I will try to explain as much as possible at very high level. So during the elections time, Biden has released a document which is a proposed tax policy. And please note that this is not a law. but this may have impact at any point of time. At any time, it may become effective. I will explain all those things when we are expecting. Okay, and the suggested changes, whatever the recommendations he is giving, those are only proposals. The bill has to go through House of Representatives and Senate before it gets signed off by the president. So at this point, it's not an act, and and we are strongly believing this will become an act at any point of time soon. There are two possibilities. All these proposed new changes will become effective either from January 1st, 2021 or January 1st, 2022. So what is the probability of implementing all these changes effective from January 1st, 2021? You can say that we are already in the February. How can he can make effective January 1st, 2021? It is possible. This is an history of different tax acts passed in the last couple of decades. Like example, if you see in 2013, it was backdated effective date. Example, in 1993, in August, a new bill was passed, Omnibus Budget Reconciliation Act of 1993, but it is effective from January 1st, 1993. So it is a retroactive. So there may be a possibility because Biden is very keen on getting more taxes. You might be following it. How much debt we have now in the US? How much funds? How much stimulus payments government is doing? Where do they get all this money? At this point, they are printing the notes, but definitely there is a higher possibility that implementing all these proposed changes effective from January 1st, 2021. So it is very important to know what changes are going to come. You should at least know. At least if you can do something before the tax act become effective, it will be saving you some thousands of dollars in tax. You may be able to save hundreds of thousands of dollars or thousands of dollars in taxes. It may become even effective January 1st, 2022 also. But still, this is very useful to know. The first one I want to talk about good things. What good things he is going to propose? What he is proposing. The first one is earned income tax credit. This is not applicable for most of our Indian community because earned income tax credit is being given for the low income earners who have kids. So I'm not going to cover in detail what is that, but that earned income tax credit is being extended to over 65 years age also. I mean, even the adults who don't have the kids, who doesn't have the kids, can also get this earned income tax credit. I'm not covering this in detail because I have not seen any of our Indians are using this at all because it's for very low income range. Number two, child and dependent care credit. You might be know if you have a dependent care FSA contribution, if you have a daycare, if you have a kids who are going to the daycare, whatever fees you pay to them in general, I mean, for the daycare, as of now, you can get a deduction of up to $3,000 daycare fees, whatever you are paying for your kids. But now there is a proposal to increase to up to $8,000. So if you have two kids, it can go up to $16,000. $16,000 is the maximum credit you can get it if you have a daycare or dependent kids who are going to the daycare. And child tax credit, very popular one. If you have kids and if they have an SSN, you can get up to $2,000, which everyone knows. But now there is a proposal to increase this to up to $3,000 per kid. And if the kids are under 6 years, you may get up to $3,600 every kid is going to get. And first time home buyer credit. If you are buying the home for the first time, you can get a tax credit of $15,000, which is a very good one. And you can even get it as an advance. I mean, you don't need to wait till filing a tax return. If you're buying a home maybe in the February, assume if the tax is if you're buying a home in February, you can go and get the credit from the government in advance. Hey, give me $15,000. They'll give it to you. And renter credit, this is designed exclusively for the low income rental tenants. So the people who are renters, if we don't have a lot of details at this point, but they are giving a proposal saying that their rent and utilities should not exceed 30% of their monthly income. So we need to get a lot more details on this rental credit. But this is a proposal given by Biden. And made in India America credit. If you are doing, if you manufacture, if you produce any material in United States of America rather than outsourcing to other countries, you may get up to 10% tax credit for your production. Okay, so all these are very positive side. When there is a positive, there is also a negative. Not negative, which may have some impact on the businesses from the tax perspective, which I'm going to cover now. The first most important thing is tax rate changes. The point to be noted here is Biden has said he wants to take more, he wants to collect more money from high net worth individuals who are making more than $400,000 only. He doesn't want to shake or move any tax rates or any bigger impacts for middle class families who are making less than $400,000. But we will go through in detail what we say. So this is a snapshot of what are the changes is going to come. Number one, corporate tax rate. If you are a C corporation, the corporate tax rate right now is at 21% as per the Tax Cuts Act, but now it is going to the 28%. Capital gain taxes, individual income tax rate, and FICA, which is a social security taxes, and Section 199A or 20% QBI, qualified business impact income, and the last one is estate taxes. So whatever the taxes, these are the proposed one, which I will go through in detail, all these 6 categories. But please note that this is only a proposal. I am just trying to bring some awareness so that you will get ready what is going to come on your way. First one I want to cover about corporate tax rate. So right now, C corporations are paying only 21% as taxes, but now Biden is increasing to the 28% going forward. What is the effective date? We don't know at this point. So this may have a very big impact if you are a C corporation. So there are different tax strategies we can implement to mitigate this risk, but considering the shortage of the time, I am not going through them. If anyone wants any guidance, they can schedule a meeting. I'm happy to guide you. Then number 2, capital gain top rate. In general, most of our Indians, where do we invest our money? 2 places: real estate, stock market. Both the things, whenever you sell, either you sell stock market stock or if you sell properties, you result in paying capital gains. And long-term capital gain, the current capital gain tax rate is 15% or 20% based on what income range you are. And if right now, just I will take that higher level, 20%, if you are at 20% tax bracket, if you are making an income of more than approximately $475,000 joint filing together, adjusted gross income, then you are come under 20%. But it may go up to 39.6%. And this is what they say is no more long-term capital gain rate for high net worth individuals. I will explain in detail. So what does it is? So as of now, we have only 3 rates: 0%, 15%, and 20%. And if your income is more than $1 million, you are a high income individual, then your tax rate, the capital gain tax rate is become individual tax rate, which can be 13.6% if you are making more than $1 million in income. And then, so this is what a snapshot of capital gain tax rates. As I was saying, as of now, if you are filing a married filing jointly, if your income is more than 501,000 for 2021, then you need to pay taxes more than 20% for the capital gain. But going forward, if your income is more than $1 million, it is 39.6%. So you need to be aware, and you need to plan how to, if you want to sell something, sell it. And if you are a high net worth individual, and if you want to sell something, sell it before this tax act becomes effective. Number 2, the next one is top individual income tax rate. So the Biden currently, the highest tax bracket at this point is 37%, but now it is proposed to increase to 39.6%. So as of now, we have 10%, 12%, 22, 24, 32, 35, 37. Now we are getting one more line, which is 39.6%. And as just I want to read this, what Biden says. Joe Biden will not raise taxes on anyone which are making less than $400,000. But I mean, he specifically mentioned he wants to get the fair share of taxes from the wealthy Americans and big corporations to pay. If you're a small individual, if you're a small self-employed, if you're making maybe $100,000, $150,000, you are not impacted because of this increasing in tax rates. But if you're a high net worth individual, for sure you are going to be impacted. And provided if it's become act. And the okay, yep. Okay, so sorry. And as I was saying that if its income is more than $400,000, then only it is 39.6%. So this is the snapshot of what are the current tax rates, what is the expected tax rate. Example, if you are making maybe some $600,000. Okay, for married filing joint, if you're making some $700,000. Earlier it used to be 37%, but now it is 39.6%, which is a 2.6% impact on every dollar you make more than $400,000, which is a very big number, which is a very big impact if you're a high net worth individual. Then FICA taxes, self-employment taxes. If you're familiar, self-employment taxes needs to be paid only up to an income of $142,800 for this year 2021. For the last year it is $137,700, but this year it's $142,800. How does it work? Earlier, I'm sorry, now right now, 6.2% being contributed by employee and the matching 6.2 will be done by the employer. But now see what changes are going to come now. Currently, the 6.2 both are doing, and if it's more than $142,800, they don't need to pay employee or employer. Both doesn't need to pay social security taxes. But if you see here, with this Biden new proposed changes, what they say is, if your income is more than $400,000, again you have to pay 12.4% social security taxes, 6.2 plus 6.2. So this is called donut hole. If your income is between $142,000 and $400,000, there is no impact to your social security taxes. But if your income is more than $400,000, you need to start paying again social security taxes, which is 6.2 as an employer and also as an employee. So this is a very big change, which is impacting all high net worth individuals. Then top effective rate on tax pass-through entities. So if you are a small business owner, you might be familiar with the section 199A deduction, which is a qualified business income deduction, which has become effective after our Tax Cuts and Jobs Act. So if you are a S corporation owner or if you are in an LLC, whatever income you make, you get a flat deduction of 20% as long as you are within the limits as a qualified business income. And if your income is more than $400,000, you are going to lose this 20% qualified business income deduction. This is a very big impact on lot of IT company business owners also, and all IT company business owners and other non-IT also. If you are a business owner, if you are self-employed, and if your income is more than $400,000, this 20% QBI is going to phase out after $400,000. This could be a very big impact. Then estate tax rates. Right now, the current estate tax rates are for this year 2021. You can transfer your estate from, I mean, parents can transfer their estate to the next generation, legal heirs, up to $11.7 million, and they don't need to pay any estate taxes at the federal level. But the Biden has proposed saying that it will become $3.5 million. So there is a reduction of $8.2 million in estate taxes. It would be a very big impact if you are a high net worth individual, if you have a lot of assets. So what you should do is, you should do some transfers, or you should work with your estate attorney or estate planning tax expert to how to reduce your estate tax liability. So, and there is one more change. Earlier it used to be 40% tax rate, but now it is 45%. So this is a very big change. And the other important change is, right now any person in US can give gift to any person in US up to $11.7 million in the lifetime. It is like all of you guys in the call, everyone can give gift to me up to $11.7 million. Just I'm taking some example for easy understanding. It's a lifetime. But going forward, once this new policy gets effective, the maximum lifetime gift amount is only $1 million. So, and other big changes are itemized deductions. If you are filing an itemized tax return, there are some big changes are going to come. The Biden plan proposed to there are several changes are coming at itemized deduction. They want to eliminate the $10,000 limitation on SALT. If you are paying any property taxes or state taxes at this point, this year, if you are filing your tax return or next year or last year, the maximum you can claim towards property taxes or state taxes are only $10,000. But now Biden is saying that no, there won't be any such restrictions going forward if the policy gets effective. But the other thing is, if the income is more than $400,000, they want to maximize the itemized deduction to only 28% of the adjusted gross income. It means, example, right now, this year, you can do charitable donations of 100% of your income. If you make $100,000, you can donate $100,000 to someone as charitable donation. But now there is a limitation of 28%, the maximum. And if you are high net worth individual, again, there is a very big impact on your tax return. All these strategies, every element, whatever we are discussing, will result in increasing your taxes if you are in a high net worth individual. And retirement accounts, see this is also a very big change. In general, whatever you contribute to a retirement, 401k, IRA account, you get a tax deduction for that. But now, what he's saying that is, it will not be any more deduction. It will be a refundable credit. So we need to get a lot more details. But this is a big change. They're saying that I think 26%. I think they're going to implement their limitation, how much money you can contribute to your 401k and IRA. What you should do now? Maximize your contributions now before this new policy gets effective. It will happen either this year or next year, but it will happen. Why it will happen? Senate and House both are dominated by Biden's team. So my House, there's higher probability, but I cannot comment anything. We don't know. We cannot forecast that exactly. But there is a possibility of implementing all these changes. Then other additional proposals. If you are you might alternative minimum tax. If you're a business owner, you understand this concept. There is a book profit, there is a tax profit. There is always, most of the scenario, there is a difference all the time between book profit and tax profit because of maybe claiming a depreciation. Some expenses are not allowed in the taxes, but in the business you have it. So what they say is, many business owners, even though they have the business profits, but they are filing tax returns at losses because of the maybe depreciations or carryover losses, whatever it is. But now they're proposing saying that every business owner has to pay 15% taxes as alternative minimum taxes based on the book profit if their business has more than $100 million income, book income. If your business doesn't have $100 million income, you don't need to worry. But if you have, then this is also a very big impact. And one more thing, as I was saying, most of Indians, we invest startup money in the real estate. You might be familiar with the 1031 exchange. So, but now this 1031 exchange is maybe removing completely. So there is a proposal as per this new policy. There is the proposal to remove 1031 exchange and also removal of investment in the opportunity zones. It's a capital gain tax saving strategies. You may be losing both. There is a proposal to remove both the strategies, 1031 and also investment in opportunity zone funds. And so if you have a lot more questions, I broadly covered at very high level. If you still have the questions, if you think that, hey, you want Anil, what to do if I get more questions? Nothing to worry. This is my Facebook page. You can log on to my Facebook page. You can like to my Facebook page. Every week, Every week, Wednesday afternoon, 12 p.m. PST or 3 p.m. EST, I will be live to answer your questions. One week, I am exclusively designing on tax planning, and the other week it's on COVID stimulus package. You might be knowing about me. Otherwise, you can get onto my page. You will know I'm a national level stimulus package expert. I helped business owners to get more than $100 million in different loans, PPP loans and other loans. So every week, every Wednesday, you can join my webinar, live webinar. Webinar is a series. One week, every week, you can come and ask me any more questions. I'm happy to do it. And you can open your camera and scan this barcode. A pop-up comes up. Just over like my Facebook page. You will follow all my updates. Then many, as I was saying initially, people think people don't spend time on saving taxes. What they think is, hey, if I do all this, I will save $1,000, $2,000. It's not worth of our time. No, this is wrong. By implementing lot of tax saving strategies and working with the right tax expert, you can save lot of taxes which you can't even imagine. So there is a higher possibility when this can be done only when you plan in advance. And so what are the next steps? You need to understand for your scenario. You need to understand what is the current law, what is the proposed tax law. You can set up a one meeting with me. This is my website. Just go to this. This is a link. Just go to this link. Schedule a one-on-one meeting with me. I offer a free tax assessment where I will go through in detail how it is going to impact your business, how to do the tax planning for your business, how the Biden's proposal is going to impact your business. I have more than 150 IT companies as my clients. I'm a tax planning expert. I do also have a lot of doctors and other real estate agents, real estate investors as my tax planning clients. So I'm happy to help you if anyone need anything. And if we also file tax returns for you. If you are an individual or business owner, doesn't matter. If you file your tax returns by February 28, we are giving a 15% deduction. We have clients in 34 states, and we can file the tax returns in any state. And we are happy to file your tax returns irrespective of whether you are. It's 100% remote. You don't need to. You don't need to just call this number and schedule a meeting, or otherwise start working on the filing a tax return. And whatever we do, how many CPAs or tax accountants in the entire US are offering this? If you file a tax return, we offer IRS audits and IRS state audit, any audits or IRS notices. We take care of that. You don't need to worry. Once you file your tax return, we take the responsibility, and we offer free personal financial planning to ensure that everyone has taken the right steps. All my clients, a licensed financial advisor will sit with you, design your retirement planning, design your kids' education, design your investment strategies, and design your family protection. Everything. Family free personal financial planning we are offering. And I am open for the Q&A. And thank you very much for this opportunity to the NATS and to all the attendees. And this is all my contact details. You can email me directly. You can call our office number. And I wrote a book on tax saving strategies. If you're a business owner, I strongly recommend you to download this booklet. And if you want a free tax assessment, just schedule a meeting. You don't need to pay anything. Just schedule a meeting and see. I'm happy to help you in whatever way you want. And I am open for questions.
Thank you very much, Anil Garu. I'm delighted to bring up some of the questions from our members to you. It was a wonderful session. To start with, the very first question is, what is the deductible amount for HSA account?
$7,100 for a joint filing family, for a family.
Thank you. And the next question is, this is with respect to hiring children in the business. Does hiring children also applicable for LLC?
Answer is yes. Yes.
The next question. Yes. Thank you. The next question is, to avail child tax credit, what would be the child age?
Okay. There should be a dependent, and it should be under 18 years to get the $2,000 child tax credit. But they should have SSN number. Even they're born on December 31st of the year, still they are eligible to get the child tax credit.
Got it. This is with respect to backdoor Roth IRA, and by the way, it was one of the fascinating alternative that a lot of us don't know. So the question is, can we do backdoor Roth for 2019 and 2020 now?
2019, no, because 19 is over, but 2020 you can do and 21 you can do.
Got it. The next question is, what does the 400K income limit refer to with respect to AGI or gross?
Adjusted gross income.
Got it. The next question is, the rollover IRA account is tax deferred account.
Okay. Rollover IRA, yes, correct. Rollover IRA is a tax deferred account. Yes. You need to pay taxes when you withdraw in the future.
Got it. The next question is, my company is offering 401k and Roth 401k. How can I take advantage to contribute to both or one?
Okay, this is a very good question. I always recommend look into your numbers first. In what tax rate you are. If you are in less than 32% tax bracket, I recommend you to pay taxes now. Go for contribution to the Roth IRA account and start saving money. I'm sorry. Let me rephrase it. If you are less than 32% tax bracket, so then build a tax-free wealth by contributing to the regular 401k and tax saving. In the future, you can pay it. In other words, if you're a high net worth individual, if you're more than 32% tax bracket, then I strongly recommend you to enjoy the tax benefits whatever you get by contributing to the regular 401k. If you're in less than 32% tax bracket, and if you think you will be at much higher tax bracket by the time of retirement, so then I recommend you to go and contribute, go and pay taxes now and save the taxes for the future. And you can also do the mix and match 50-50%. And but as I was saying that you need to look into your applicable scenario. You can schedule a meeting with me. I'm happy to help you on this.
Thank you. On a related note, are Roth IRA and Roth 401k both same or not?
No, both are not same. So both are separate.
Got it. The next question is, to convert traditional IRA to Roth IRA, does it need to be done every year, or can it be done when we need to withdraw the amount?
Okay, it has to be done. I mean, to build the tax-free wealth, it has to be done on every year basis, year-on-year basis. So,
got it.
And actually, I mean, what I recommend is, if you are going for a backdoor Roth approach, I recommend you to contribute now. The next day, convert into the Roth, so that there won't be any tax impacts.
Got it. The next question is about refundable credit. This is the proposed Biden changes. Would you please shed some light on how the refundable credit might be proposed?
Okay, refundable credit is there. It is there for multiple things. Refundable credit is nothing but get the money in advance. If for suppose, I will tell you one thing. Renter first time borrower credit, which is a refundable credit up to $15,000. If you're buying a home and when you file your tax returns, if you need to pay taxes to IRS, you can take this as a deduction. Example, you need to pay $25,000 as a taxes to IRS. You say that, hey, I have a refundable tax credit which I can apply and pay only the difference amount. Second example, if you don't have so much of liability, an example, if a tax liability is only $8,000, but you have a credit of $15,000, then IRS will give you back the money to you. The difference amount they'll give you back. That is called refundable tax credit.
Got it. Next question is, I already paid Roth IRA for 2020, but my income is more than the limit. What can I do?
Okay. Now there is nothing. I mean, there is nothing. If you already contributed to the Roth IRA account, it's good. You are building there. You are contributing, and you are building a tax-free wealth, which is very important. So generally, what people do, if you have the money, you may put the money in the stock market rather than you put on your own. Invest the money through Roth IRA account, and it grows tax-free completely. So there is no action required from your side.
So can he withdraw that amount or no?
Okay, you can withdraw the money after 5 years. You can withdraw the principal amount, and after that, For the Roth IRA, account, you can withdraw money because you didn't get any tax benefits. It doesn't matter.
Got it. And the next question about the child employees. What is the earliest age that a child can be a part of an employee in an organization?
Okay. I recommend to get to at least teenagers. Of course, you can become even much younger, but you need to build the documentation to prove that they are working. If you think that your kid is smart, if he's younger at 9 years, 10 years, also may be possible, but you need to build a lot of documentation for that. But for the teenagers, it's very easy to build the documentation.
So we understand that there are two variations of it, like parents has to be part of the LLC, or if they are part of a S corp where they are paying the social security taxes, which one would you suggest as a tax planner?
Of course, as a tax planner, I recommend. I don't want, if there is a way to save taxes, I recommend you to do that. So if you're an S corporation, you have to pay social security taxes when you hire kids. Rather, there is one more option. It's called family managed company. You can incorporate it. You can create an S corporation. You can transfer the money from the S corporation to. I'm sorry. You can incorporate a sole proprietor, which is called family management company. Every month, you can transfer the money from your S corporation to the sole proprietor, and you can do the payment. You can go to the YouTube, go to my playlist. There is an exclusive webinar I have given, the live show I have given on this topic, hiring kids. You can go back to my YouTube channel. I explain in detail, step by step there. But yes, there is a way, but you have to create a separate sole proprietor for this.
Got it. And we heard about the gift, the max gift amount that is being reduced from 11.2 to 1 million. And we often get some confusion. There is some myth or some maybe the reason is like if an individual cannot be transferring more than 15K to another individual, unrelated. Is that true, or is there any policy like that? What is the max that an individual can?
No, okay. Anyone can give gift to anyone. In simple. But only thing is, if it's more than $15,000 in any year, you have to file a gift tax return. You have to inform the IRS and Department of Treasury saying that yes, I have given some gift. If it's less than $15,000, no intimation required. It's completely free.
Got it. The question from one of our members: can someone eligible for any kind of IRA, Roth, traditional, or back Roth, if the multifamily joint income is more than 206K?
Okay. IRA account, anyone is eligible. Anyone can contribute it. But Roth IRA, you cannot contribute if your income is more than $206,000. So then you need to say, but still you can contribute to the IRA, but you don't get any tax deduction. Then why do you need to contribute it? Because you need to do it because you can convert to the backdoor Roth. So you're building the tax-free wealth.
Got it. Another question: if the kids are US citizens and the parents are not green card holders, how old should the kid be to be eligible to open a C corp or S corp to start a business, basically?
Okay, if they are citizens, they can open a business at any time. Even there are small business. There are many young people who has businesses. They can open.
So there is no age restriction to open a business.
No age restrictions. Yes.
Got it. Can we use?
But of course, there is a lot of documentations are required. What is that person's, the kid's responsibility? Who is there to take care of a lot of responsibilities? But you need to work with your tax accountant or attorney on this to ensure that you are doing in the right way.
So you advise to have the proper CPA guided advice. Got it. Yeah. Next question is: can we use SEP IRA for EBS green card investment?
SEP IRA.
EB5, sorry, EB5 green card.
Okay. So for EB5, okay. SEP IRA, I think yes. Okay, if you have self-directed IRA account, self-directed SEP IRA, then you can do it. Otherwise, you will not be able to do it. Example: if you open an account with Fidelity SEP IRA account, they will not allow you to invest in your EB5 project. But if you have a self-directed IRA account, then you can do it.
Got it. The next question is about that 15K max. One person is asking, can I get 15K each from different people? For instance, can I get 3 different people transfer me 315,000?
Answer is yes.
Okay, got it. The next question is, This is with respect to the Social Security tax that Biden is proposing if it is more than 400K. Regarding the donut hole, there was little confusion. Were you saying that the difference between the 206 and 400K is also, sorry, the difference between 148 and the 400K is also payable, or only if it exceeds 400K?
Okay, it only exceeds. So you need to pay Social Security taxes up to $142,800. After
Okay.
that, there's the whole. You don't need to pay anything from 142 to $400,000. But again, after 400, again you have to start paying the taxes.
Got it.
The whole, you don't need to pay anything in the between 142,800 and 400,000.
Got it. The next question is about that vehicle depreciation. So you were saying about 6,000 tons vehicle. Anything bigger than that is eligible for? Is there any cap, or how much the max that the cap?
Yeah, the maximum is $1.15 million.
Oh, for the vehicle.
Wow, for one asset class under Section 179. Yeah. Yes.
Got it. Got it. Can you also shed some light on the businesses having the real estate property, buying the real estate property, and how they can save the taxes on that?
Okay. So if we have multiple properties, so what you can do is one of the best strategy. What I always say is have a management company. If you have multiple properties and have a management company, that management company can be an S corporation. So there is a different strategies we can implement it, but I need to understand your scenario to do more. And that is individual scenario. But I didn't cover tax saving strategies on the capital gains. But if you have a lot of capital gains, if you do a lot of real estate investments, there are some strategies are available. I have given a lot of live shows on that. You can YouTube, you can look into that. Otherwise, you can reach out. Considering the shortage of the time, I didn't cover the topic capital tax saving strategies for the capital gains. So,
got it. The next question is, can I have a HSA account if I have a regular insurance from the company?
Regular insurance, no. You need to have a high deductible health insurance plan.
Got it. Is there any additional penalty if you withdraw HSA money for non-medical expenses?
Okay, before retirement, if you withdraw, it's a 10% penalty. But after that, it's only you need to pay taxes, just like a 401k model.
Got it. The next question is, can I have both 401k and IRA accounts?
Yes.
All right. The next question, can we contribute to both the traditional IRA, ROTH IRA, and 401k at the same time?
Traditional IRA, ROTH IRA, and
401k at the same time?
Yes. Answer is yes.
But there are some the income limits.
Limitations, of course. This mix and match. There is in IRA, the maximum you can contribute is only 6,000. You can do some in ROTH, some in traditional, or the 401k you can do the $19,500 is the maximum. Again, there also you have an option: some traditional, some ROTH.
All right. The next question is, I have a question about backdoor ROTH. So basically, the question is, if I have 100k in 401k with an ex-employer, if I want to roll it over to an IRA and then convert to ROTH IRA, will I pay any tax to IRS since ROTH IRA is pre-tax contribution?
Backdoor IRA approach, what I'm recommending was only for the people who has more than $206,000 who cannot directly contribute to the ROTH IRA in general. But if you're talking about the rollovers, no, you will be paying taxes when you convert from the traditional to the ROTH.
Got it. So one member is asking, is IRA only useful when we cross the maximum limits of 401k contribution? Is that correct?
No. Everyone should have IRA account, and if possible, ROTH IRA account.
Got it. One member is requesting a little bit explanation about SEP IRA, if you can.
Yes. So SEP IRA, you can contribute only when you have self-employment. If you are a W-2 employee, then you cannot contribute to the SEP IRA account. And if you can open the SEP IRA account before April 15th, before filing your tax return. You can contribute up to 25% of your income you made on the business. And if you have an employees, you have to offer SEP IRA contribution, whatever the percentage you want to contribute to every employee. So we recommend SEP IRA for the business owners who don't have employees in the company, like W2 employees in the company. And this is just again, it has two things: traditional, Roth. Traditional is where you contribute, you get a tax deduction. Roth, you don't get the tax deduction when you contribute.
Got it. The next question is, as a W2 employee, will I be eligible to open ROTH IRA for my children by paying wages for their household work?
Okay. No, it's a very good question. Household work, you cannot pay salary to your kids. You should have a business for that.
Got it. The next question is, can you talk about traditional to ROTH conversion in detail as possible?
Okay, so 1 second. Traditional, the backdoor IRA is a bit complicated topic, and I recommend you to work with your CPS before you do it. And this is recommended for people who are high net worth individuals, or who has higher income more than $206,000. So when you contribute, anyone, all of us can contribute to the ROTH IRA, regular IRA, traditional IRA account up to $6,000. On our name, $6,000. On our spouse name, $6,000. So every family can contribute $12,000 every year first. Then, but even though you can contribute, you may not get the tax deduction if your income is over the limit. If your income is more than $124,000, you don't get any tax deduction. Then what you do is, then what is the advantage? I still follow the step number 1, contribute. Then open one more account called ROTH IRA account. Convert this entire $12,000 to the Roth in the next day. From there, it grows that money. This is step 2. Step 2, what happens when you convert? Because anyway, you didn't get any tax deduction when you contributed to the traditional IRA account. So when you convert, you don't need to pay any taxes. The next day when you converted, then invest this money into the stock market or bonds, mutual funds. If it's a self-directed IRA, then you can invest in the real estate also. So wherever you invest, that's step number 2, invest somewhere. Step number 3, it grows tax-free completely, 20 years, 30 years, 40 years, how much number it grows. Whenever you withdraw money after the retirement, it's completely tax-free. So these are the 3 steps approach, and I hope I'm clear. And otherwise, there is an exclusive video live show there in the YouTube. You can look into that retirement contributions, and there is.
Thank you, Anurag. Another question: if the income is more than 300K, is it possible to invest in traditional IRA and claim tax reduction?
No.
Got it. And one member is asking, what is the approximate fee range for tax filing for joint filing as well as individual filing?
Okay. So it depends on how much complicated, how many forms you need to file. So definitely, I mean, it is person to person change. It's not a flat rate. So I strongly recommend to call to our member. So we are happy to guide you through that.
Got it. Next question: can someone eligible for any kind of IRA if the joint income is greater than 206K?
They can contribute. Yes, they can contribute it. I mean, they can contribute only for the traditional. They cannot contribute to the Roth. But even though they contribute, they don't get a tax deduction.
Got it. And the 400K, the proposed changes, that is AGA, right? I think you answered that question earlier, right?
Yes.
Okay. The next question, we'll wrap up quick. I know we're taking a lot of questions. We have tremendous response with respect to question and answers and all. As usual, our seminars are like that. So to avoid child as a helper, what age does he need to be? I think you answered earlier as that teenage.
The teenager is what I recommend. Yes.
Got it. And then regarding backdoor conversion of IRA to ROTH can be done partly. Is it possible that IRA backdoor conversion be partly?
Yes, it is.
And once it is transferred to ROTH, can it be withdrawn?
Okay. Once you convert to the Roth, technically principal amount you can withdraw after 5 years, but the interest, whatever your money you are making on that can be withdrawn only at the time of retirement.
Got it. Can we convert SEP account to ROTH IRA?
SEP, yes. Answer yes.
Can a H4EAD start a sole proprietorship?
Yes.
Can we use child credits if we employ kids?
Yes.
This is with regard to vehicle. I see it as December 2020 in your slide. Can we assume it is a timing or it's extended? I think there's no restriction on the timing.
Yeah, there is no. It's 2021. Thanks for catching it. Yes. Yeah.
Sure. And a lot of members are asking, is it possible to share the slides and possibly the recorded session? Do you allow us, or can you share us the slides, Anil?
It's not. It's recorded. I mean, I might not be able to share the slides, but it is there in the Facebook page of NATS, and I think and YouTube channel also in the YouTube channel of NATS also it is there.
Got it. So those who are asking recorded sessions, yes, you will be able to see it in YouTube as well as in Facebook. Yes. And the next question: do we get employer matching for ROTH IRA too, or is it only for 401k?
Only for 401k.
What are the other taxes I have to pay if my salary is above 142,800?
Okay. I mean, the regular federal taxes and state taxes you need to pay. If it's more than $142,800 or 142,800, then you don't need to pay Social Security tax. That's only.
Got it. So one member is asking about whether we can withdraw ROTH contribution as my income went above the limit. Can I invest back in traditional IRA for 2020?
Yes, we can withdraw.
Okay, got it. I think the last two questions, probably we will stop taking questions. We'll give another 5 minutes and then we'll stop. Is it okay, Anil Garu?
Yeah, yes, just a couple of minutes, okay. And if anyone has any more questions, I'm happy to extend my support and help to our community. And through our NATS, it's a great platform for me to share my knowledge. I'm privileged to share my knowledge. Reach out to me, schedule a meeting with me. Happy to work with you. Happy to answer all your questions. And send me the email. If I'm not able to answer any of the questions.
Sure. One question: if the company doesn't offer ROTH IRA, then what is the best way to maximize the retirement benefit? We cannot roll over 401k until we leave the company.
Okay. So IRA account company will not be matching it. So it's an individual. It's only 401k only company matches. So it doesn't matter. You need to contribute and you can maximize it.
Got it. I think that's all we have. Thank you so much, Anil Garu. You have passed us a lot of information, especially your passion towards the Biden's 2021 proposed changes. You are very detailed in what you went through, and you were able to explain it very well and thoroughly to our members. We're all delighted. We're all lucky that you are here today to explain us the existing as well as proposed changes. We thank you so much. Our members are really happy that you are here today to go over all those changes. And I also want to thank our NATS President Vijay Garu and also Sridhar Sani Garu and our EC and Sudhir Mikaleni and Rajesh Garu, Malad Garu, and Ravi Kumari Garu, Ranjit, and all who all helped us to make this event a wonderful success. And Prashant Kanumani Garu, sorry, I missed about him. And this is really an awesome platform for all of us, and most importantly to all the members who joined and all our volunteers and committee members of Tampa Bay chapter. We really thank. And finally, we owe a big thank to you, Anil Garu. This is a really wonderful session. Thank you so much.
Thank you very much, Prasad Garu, and I really my sincere thanks to NATS leadership team and to the president and other board members also. It's a great opportunity for me. Thank you very much, and looking forward to working with NATS with many more webinars and seminars. Thank you.
Thank you.
Thank you, sir.